You are listening to Keystone's Stock Talk Show, episode 290.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again this week. This week, in light of the volatile political and economic environment centered in the U.S., Aaron will provide a State of the Union type economic outlook. In our Your Stock, Our Take segment, I will begin with a viewer question on Valu Holdings, symbol PET on the TSX, Canada's leading retailer of pet products with a growing network of corporate and franchise stores across the country. In a tough environment, the company has reported Q4 numbers that beat estimates, but has a muted outlook for growth in 2025. We take a look at the valuations of the solid Canadian dividend growth stock. Brennan answers viewer question on Tesla Inc., symbol TSLA on the NASDAQ, the Elon EV leader, which after its initial Trump bump is down 13% as we record this segment today and over 40% year to date. Brennan revisits the financial performance outside the noise and outlook moving forward in a new environment. To close out our show, Brett revisits a company we will be interviewing in person next week at a California conference, the Roth Conference. Perion Network, symbol PERI on the NASDAQ. Perion is a provider of advanced technology for digital advertising, which trades close to cash value after a volatile and down year. Brett lets you know if the current fundamental situation and outlook is solid ahead of our in-person meeting with the company. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees. Brett and Brennan, how are you guys doing?
Very well, thank you.
Hey, good.
How are you?
Good. Well, we have upcoming webinars. So our first of the year that we're announcing today, those will be April 8th and April 3rd. So the first one in April 3rd at 7 p.m. Pacific, April 8th at 7 p.m. Eastern. We also have a full VIP webinar on April 13th. That's the complete package there. You can go to www.keystocks.com and get information about that. What are we going to talk about at these events? One section is on Trump, tariffs, and your portfolio, but from crisis comes opportunity. Which stocks to buy and avoid in this market? We're going to review the Magnificent Seven. So with a buy, sell, hold approach, Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, Tesla, which to avoid, and potentially a new buy on the horizon there. We're going to look at commodity stocks, gold, oil, copper, uranium. Is there a coming commodity boom or should you sell now? We're going to have two buys in that segment. We're going to look at the orphan stock opportunity. Why and what are orphan stocks? Real cases showing 100+% gains over the past 12 months in some orphan stocks from our Canadian small cap universe. You'll also receive a starter portfolio, 5 to 7 profitable growth stocks that you can start buying today. Profitable orphan gold related stock trading at about 5 times earnings. Our top dividend growth stock with a 5% plus yield, a cash rich profitable gold stock, a cash rich retailer, which could be the next Aritzia, and a cash rich energy stock, as well as a IT stock that is a tariff proof company for your portfolio. So again, those starting webinars, the first one, April 3rd, 7 p.m. Pacific, April 8th, 7 p.m. Eastern. And that is my soapbox on those for this week. We look forward to seeing all our clients and potential clients to be at those events. They sell out every year, so get your tickets. I think in the email that we send out for this and on YouTube, we'll send a link to where you can get your tickets for those, our first webinars, live webinars of 2025.
Yeah. Well said. And I think what everybody is wondering right now is, like, what do you do? How do you position yourself and your portfolio in this kind of a market? Because we are really facing, I would say, unprecedented. And the word unprecedented is used a lot, but it is unprecedented in many ways. Some of the uncertainties that we're facing, a lot of opportunities as well. But there are, people have questions like, what does this mean for their portfolio? How do you position yourself? What kind of stocks to buy? What to avoid? Industries, themes, that kind of thing. So that's really what we're going to cover. It's our strategy, which is consistent over the decades, but the strategy is consistent, but the tactics can sometimes change a little bit depending on the market, the current market dynamics. So that's really what we are going to be focusing on in the seminar.
Mm-hmm. Excellent. And we look forward to providing that to anybody who's interested in helping them build that simple 20 to 25 stock portfolio. We'll show you how to build it, give you some suggestions of what you can put in it, and give you certainly some hot button topics that we're looking at right now in the market to provide you with some good advice going forward. We also, we're going to a conference next week. Myself, Brett, and Brennan are headed out to the Roth conference. There's about 550, 600 companies this year, probably the largest we've seen in terms of companies. We'll be interviewing likely 20 to 25 companies at that event. We've looked at every company ahead of time, reached out, and we'll set up those interviews. Some companies we have in coverage we'll sit down with, some new potential buy recommendations there. So we look forward to that. That starts next Sunday to Wednesday, and then we'll be back in the office on Thursday. So should be good. And Aaron will be on vacation, right?
I will. Yes.
Yes.
He wants to not say that I won't be attending, and since we started attending it,
it is a good event, and it's crazy. It's a finance event, and it's right Laguna Beach area. It's a beautiful location, but we're sitting there doing like 15 meetings a day. It's quite tiring, quite exhausting, but at the end of the day, they do treat you well. And I know that they're pulling in a band, the Goo Goo Dolls. If anybody knows that, they'll be there. And Brennan will be rocking out to that. Or there's a country band that Brennan is really looking forward to, aren't you, Brennan?
Yeah, I think it's Thomas Rhett.
There you go.
Not that, to be honest, I'm not even a big country guy, but I'd start singing Iris from the Goo Goo Dolls right now. I can't say it. But I'd probably get copyrighted, so we would get a copyright infringement. So, because I've got that great of a voice.
Yeah, you're that good. All right, let's get to our poll question. It's on the AI bubble.
Yeah, this is actually, I guess, pretty timely now that we're recording this on Monday the 10th, and the stock market's plunged throughout the day. So, bit of a timely poll. So the question is, the AI king NVIDIA has lost over $1 trillion in market cap after hitting a record high earlier this year. Has the AI bubble burst, or is this just a blip in the market? 44% of our viewers said the AI bubble was burst, and 56% has said this is just a blip, or there just isn't an AI bubble at all.
Yeah.
And where did you gentlemen sit on that?
I voted that it burst, but I mean, I have no idea. Like I was reading an article, from Forbes, like this was in January here, so just a couple months ago. And just this article was talking about, just that, there's a lot of experts, saying that we might see 2025 as the year where the AI bubble bursts. Like, for example, like there was a quote from Baidu CEO where he says, people would be disappointed that the technology doesn't meet the high expectations generated through the initial excitement, and said that only about 1% of companies will endure when the AI hype fades. So, I was reading this article. I thought it was a little compelling. But really, who knows?
There was some silly valuations, and there is still in some companies. And like some of the AI leaders are really the biggest of the big in tech. They got to stretched valuations, and now they're not crazy, at all, if you given the size and the growth in some of those companies. But the ancillary companies, many of the companies that didn't have the revenue base or the profitability at all, there was some crazy valuations. So bubbles in terms of valuation burst, I would hope it's healthy for the markets to get rid of some of the silly valuations that were there.
Yeah, I mean, I think calling the valuation silly, overheated is accurate. I don't personally see it as a bubble, and certainly not a bubble like what we saw in the .com bubble. That level of speculation wasn't really apparent, at least with the larger companies. I agree that once you get into the, outside of the larger, the leaders that have good solid profitability and growth, and start getting into the, companies that aren't generating cash flow or losing a lot of money, and then in some cases aren't even generating revenue, that's when it starts to look more like a bubble. But it's a mixed market. I think that whenever you have an important technology like this, you're going to see the excitement ebb and flow. And there's a huge amount of excitement now. Maybe some realism returns, but I do think that we will see continued growth over time with some volatility.
Yeah, and a company which I'll highlight just on the smaller side, because we obviously have NVIDIA and other names people will know off the top of their head, but Big Bear AI, which I covered as a star 3 weeks ago, and it was something like just under $9 a share at the time. Now it's back down to $3 a share. That sentiment within that company alone has really came off after just such a run after a short period of time. It ran up 300% or I guess up 200% in a period of like a month and a half. And now it's right back down where it was prior. And that really just shows that shift in sentiment just in such a short period of time.
I think that is your case right there. An excellent case of the silly valuations, really. I know that's perfect. So before we might as well get into the, I was going to say too, there is a mug we're giving away. We're mugging somebody over the next week. So get your questions into our Your Stock, Our Take to get entered in to win that mug, and we'll be giving it away next week. So Aaron's going to do a State of the Union. We might as well give him the floor for that one in terms of the economy.
Yeah.
Okay, perfect. Now that we're a couple months into the first quarter of 2025, and obviously this has been a very a lot of news has come out this quarter, a lot of changes. So what I wanted to do is review some of the key economic indicators that have come out and just discuss what this means for the overall global economy, and then as well what it means for individual people's portfolios, and just give an idea of kind of how we address a scenario like this. So the question we really want to know, and what a lot of people are asking, is the world heading into recession, or as many people are referring to it right now, a Trump session? So what I want to start with is some forecasts for US GDP in the first quarter of 2025. So right now, early March, we're a couple months into the quarter. I believe that the actual quarterly data comes out around April 25th, but GDP Now just recently provided a major reduction in their economic forecast for Q1. Right now, GDP Now is forecasting negative 2.4% growth for the US economy, GDP-wise. But when you look at the trend here, we can see that just back in February, these forecasts for GDP Now were between about 2 to 3%, and at one point we're over 3%. So we've seen a major reduction in the forecast for the U.S. economy, and I think it's important to take a look at this and just discuss kind of what's driving it and how investors should look at this. So first of all, what is GDP Now anyway? So GDP Now is a forecast provided by the Federal Reserve Bank of Atlanta. And what it does is it obviously forecasts the GDP of the US, but it does this in a different way than typical forecasts. So this model provides a now forecast, which means that it incorporates real-time data. And this forecast is always changing. I think it changes every week or two. They essentially update it. Now, if you look at traditional economic forecasts, typically you might get one or two upgrades before or revisions before the actual data comes out. But typically, you're looking at a lot of trailing data or a forecast that is at least a couple weeks or several months old. So what this now forecasting does is it just incorporates more real-time data into the analysis. Now, this is not an official forecast of the Atlanta Fed, but rather they describe it as a running estimate of real GDP growth based on the available economic data for the current measured quarter. So if you want to get more information, you can go to the Atlanta Fed website. Now, the question is, how accurate is GDP Now? So this is somewhat difficult to assess because unlike traditional economic forecasts, this forecast is always changing constantly. So if you're going to test the accuracy of it, you would need to do that at a certain point in time. But there is some information out there. So according to a report issued by the Fed of Atlanta, on average, GDP now, as expected, becomes more accurate as you get closer to the GDP release date. So in our case, this is going to be April 25th. And right now, we're about 45, 46 days away from that. But when they do their analysis, they figure that 90 days before the release, on average, the absolute error is about 1.1 percentage points. And then right before the actual data is released, that is reduced down to about 0.5 percentage points. So given that we're about 45 days, you would expect on average for us to fall within that 0.5 to 1.1% band there. Now, of course, when they're estimating a decline in GDP of 2.3%, even if they're off by the 1.1%, you're still looking at negative growth compared to what only a month before was expected to be a positive GDP growth quarter for the US. So this is significant. There are other indicators that have come out. There's the Consumer Confidence Index as measured by the Consumer Board Confidence Index. So this fell to 98.3 in February, down from 105.3 in January. So this is the largest monthly decline since August of 2021. And of course, about 70% of the US economy is driven by consumer spending. So consumer confidence is a major factor. Interesting enough, the trade deficit, they widened substantially in January from 98.1 billion to 131.4 billion. Now, of course, with the way that Trump always talks about the trade deficit, this may or may not be an issue when he starts talking about it again. But certainly his intention was not for his rhetoric to increase the trade deficit. Now, a lot of people will say, well, he didn't even take over until later in January anyways. So would this have anything to do with the current administration in the US? And I think that that's a very good point to make. However, since the election in November, he's been very vocal. The administration's been very vocal about what they were going to do. And that has certainly driven a lot of business and consumer behavior as well, even before the administration took over. So one of the rationales why the trade deficit has expanded so much in January is because a lot of the companies in the US, fearing that tariffs are coming, pre-ordered a lot of their equipment and product, fearing that they would have to deal with tariffs in the future. And of course, the stock market has not performed well this month. The S&P 500 down 5.7% just since the start of March. So not even 2 weeks into the month here. So in terms of economic outlook, we would ask ourselves, so what does all this mean? Why are we seeing lower consumer confidence? Why are we now seeing forecasts lower for GDP? Essentially, what all of this means is that a picture is being painted of strained growth. So the economy in 2024 had a decent year of growth, but it was already showing some signs of slowing. And now we're seeing that continue. We're seeing persistent inflation. People aren't really sure what the Fed is going to do, especially now in the face of other uncertainties. So while employment remains robust and the overall economy in the US continues to remain robust, there are a lot of significant challenges that the US economy faces. And unfortunately, there's been a substantial amount of uncertainty that has been injected into the global economy. And when I say uncertainty, this is the on and off again tariff threats from the Trump administration, and really a fundamental shift in the way that the US deals with its allies. And many U.S. allies coming out and really questioning their future relationship with the U.S. So this creates uncertainty, and business investment doesn't like uncertainty. The markets don't like uncertainty. If you're a company that is considering a major investment, but you don't know if there's going to be tariffs, or if they make an agreement, you don't know if that agreement is going to be followed through. You don't know who your country's allies or enemies are. When that uncertainty is high, people just put off making investments. And when they put off making investments, the economy suffers. So none of this should really be any surprise given what's been going on in the news cycle right now. So what is our strategy in a situation like this? Because I really don't like to talk about economic indicators a lot because it's really difficult to incorporate this into an actual investment strategy. But just on a high level approach, we really think that you need to focus on the things that you can control. And one of those things is staying rational. So it's easy to follow the news cycle. It's easy to invest emotionally, but it's very important to really focus on making rational decisions. Don't make investment decisions when you're feeling emotional. Don't make important decisions after you doom scroll on social media for an hour. Maybe the best time is to just set a certain appointment with yourself first thing in the morning on a certain day where you review what you're doing with your portfolio and make your decisions then. And then for the rest of the day, you don't have to think about it. When you are looking at your current portfolio, certainly reviewing the level of direct tariff exposure that those companies have. Certain industries are going to be more exposed than others, so it's really important to know where you're sitting. We're looking for companies right now in terms of individual recommendations that have good global diversification, as well as flexible supply and customer chains. So they're able to adapt if indeed tariffs come in or there's a major change in the trading relationship or a significant change further in the trading relationship with the United States and Canada. We're looking for mispriced opportunities in periods of volatility. So we are seeing the market start to react to all of this uncertainty. In some cases, that's justified. In many cases, we think that valuations are too high right now, given the uncertainty that we're seeing. But there are a lot of individual companies that may be relatively unscathed by what's happening, or whereby the risk is not being properly understood by the market, or where they can adapt to the situation. And where we're able to buy these companies at attractive prices, we'll look to do that. We do think that having some U.S. exposure certainly remains wise, just given looking at this from a diversification perspective. Always, we're focusing on profitable businesses that are solving real problems. So when you look at the types of businesses that you invest in, when you're investing in companies that are profitable businesses that are providing services and assets that are essential things that society needs, that are solving important problems. These are the type of companies that are going to be able to adapt to the current environment, and also find ways to grow or come out the other side of the volatility in strong condition. So these are the types of things that we're gonna cover at our live webinar coming up, DIY webinar. It's going to be in April. We highly recommend anybody who is interested in understanding what's happening in the current environment and what decisions you can make or what you can do with your portfolio to help you mitigate that risk, expose yourself to opportunities, and avoid bad investment ideas. We invite you to attend. There will be a lot of these. A lot of the revised numbers will be out by the time this webinar happens. So we'll be able to look at what some of those economic indicators are saying, such as the revised GDP estimate, and then incorporating that into our analysis.
No, that's a good summary of the current economic conditions and what we're doing, and some of the from all these crises comes opportunities. We have a monitor list of like 20 companies in the US, 20 in Canada that we would like to buy. But we've seen high prices for, 18 months at least in a number of companies. And now you see, companies coming, you're not a kid in a candy store. It's nothing like that. There's certainly uncertainty out there. But, companies are starting to trade at mid, at least, to sometimes in some cases the lower end of their 5-year average price to cash flow or something. So you're starting to see a little bit more historical value than you had certainly end of last year into the start of this year.
So you're saying there's not blood in the streets yet?
No, we're not near that. And people, I know that like we get clients saying, "Oh, this must be an absolute screaming buy right now." Well, you have more uncertainty. Plus, if something was potentially 40% undervalued and it comes down 20%, or overvalued, and it comes down 20%, it's still not, even if it comes down even more than that, it might come down to which is just fair value. And now you've got higher risk in the market than you had, say, 6 months ago. So you have to factor in current risk. If you're looking long term, there is starting to be some interesting situations. There are some companies that are completely unaffected by tariffs. Like if you're, there's one company in our coverage that makes an iron supplement, and like we've had a hold on the stock in the near term, and if it comes down to a certain range and we tell our clients what the range is, that would be, again, a buy if you're looking 2 to 3 plus years out. It hasn't hit that range yet, but it's starting to get close to that range. And that is a time where we would add that company because, again, your iron supplement, if you're iron deficient, you're taking that regardless. So regardless of whether there's a tariff war, you're not going to say, oh God, I need to not take my iron because you're iron deficient. You got to take it. So there's certain companies that if they become cheaper because the environment is more risk off, those are the companies that you're going to take advantage of and buy because they're really not affected at all.
And I just want to highlight, this is from Linamar's conference call. They had a conference call last week now. And this is just from the executive chair because it really brings out the mindset of these companies dealing with tariffs. So they say, we are not contemplating closing facilities in tariff-affected countries and shifting production to the U.S. tariffs, as we have seen played out literally in the last 24 hours, can be implemented one day and removed the next day. They are short-term tactic. We make important decisions such as where to manufacture based on long-term fundamentals like availability of talent and bench strength and supply chain availability and costs in the region, not something short-term as a tariff. So they're long-term view, and that's what you're going to see across these manufacturing companies because it takes years to build out a facility, years to build out a supply chain. And that, as much as Trump wants to see, you can't move that overnight. You can't move that in a month, even if there is a month up wait for tariffs, whichever variant he's done. He's already done it twice now, really.
Mm-hmm. No, it generally, like some of the information, the data that I read, it generally to build a manufacturing, like a significant manufacturing facility in virtually any industry, when you're starting from the planning phase, the very early phase, is a minimum of 5 years, right? Minimum of 5 years before you could actually see any major shift. Now, I'm sure that there's variation to that depending on the type of facility and size, but I mean these are multi-year things. And then these supply chains have evolved over decades, and they evolved the way that they did for a reason. So even when somebody's sitting here looking at making a 5-year decision to build a factory in the US, why would they? I mean, you would have no idea if tariffs are going to be on or off over the next year, never mind what's going to happen in 5 years. So I just think that typically what people do is they delay investment decisions until they feel that they have enough clarity. And when they do that, that means less activity in the economy, and it has a ripple effect. So, yeah. I mean, the economy, I'm not trying to forecast or say anything about GDP Now's forecast or whether it's going to be true or not. I can't see a scenario where all this uncertainty is anything but very negative for the economy. But the economy is a very complex organism. I mean, it's very difficult to predict. So there are a lot of different factors that are going to come into play. But uncertainty is definitely a major push in the direction of negative economic growth, certainly.
Yeah, and from interviewing management teams over the past couple months, the one thing that they're stressing is there's just a kind of a freeze up of capital in the near term. People are just sitting on the sidelines, not making the big investment decision, and that probably extends 3 to 6 months. You probably get some normalcy, maybe you don't, or the new normal becomes you have uncertainty, and then they start at some point they have to make those investment decisions. So. Mm-hmm. It's probably just smart to delay them right now. So you can see that. Aaron had touched on something there too. There was preemptive purchases. Probably you may see that noise in the next quarter from some companies that supply that were over purchased. They stuffed their inventory because of a threat of tariffs, and then you might see a lull. There's going to be some weird, strange items in the numbers of companies over the next couple quarters, I would say. We're also going to get the gauge on just from the CEO or C-suite perspective next week when we sit down with 25 management teams across multiple sectors. And, part of the questions what we'll ask is, how are you feeling about the environment just generally? And we will get a general broad range of opinions from the C-suite of a number of mid to small to even there's some large cap companies at this event. Yeah, so it's a great event to be able to judge that right straight from the horse's mouth, so to speak.
Highly valuable.
Yeah, for sure. Okay, I am going to do a brief kind of update. I've looked at them in the past. Is Valu Holdings Ltd, symbol PET or PET on the TSX. Trades around $26, 100 or $1.86 billion market cap, 1.78% yield. Pet Valu, what do? They're headquartered in Markham, Ontario. Good Canadian company. Pet Valu is Canada's leading retailer of pet products with a growing network of corporate and franchise stores across the country selling a combo of proprietary and third-party brands with an increasingly omni-channel approach, selling in person and online. The company also has a substantial wholesale platform servicing the majority of its inventory needs at its franchised locations. Let's look at the stock. In a weak market, stock is actually up 4.79% year to date after reporting Q4 numbers that beat street estimates. They were lowered estimates, but they beat them. But the shares are down around 16.85% over the past year, again, in a tough macro consumer competitive environment. Let's take a quick look at this company's Q4 and 2024 annual numbers released last week. For the year, as we can see here, revenue was up to $1.097 billion. That's 3.9% increase. Net income, about $87.4 million or $1.22 per share, down from $89.5 or $1.26 per share. Adjusted net income was around $1.57, down from $1.61 in the same period or in 2023. So let's look at the fourth quarter here, zero in. Oh, there's those numbers I've highlighted. Thank God we did that. Look at the Q4 specifically. Revenue was $295.1 million, up 2.9%. Adjusted EBITDA was $68.2 million, down 4.3%. And net income was $28.9 million, up from $28.8 million in Q4 2023. The increase in net income is primarily explained by lower net interest expense and lower income taxes, partially offset by lower operating income and higher loss on foreign exchange. But if we look at adjusted net income, it came in at 45 cents per share. That is down from 54 cents in the same period last year. Pet Valu opened 19 new stores. They have 824 stores across its network. Pet Valu also introduced their 2025 outlook. We can see here, fiscal 2025 will be a 53-week period, so one additional week compared to the 52 weeks in fiscal 2024. So again, that's that one additional week. So the numbers here, revenue between $1.17 billion and $1.2 billion, supported by 40 new store openings, same store sales growth, that would be between 1% and 4%, and higher wholesale and merchandise sales. So that's about 7 to 9% growth in revenues overall. Adjusted EBITDA of between $245 million and $260 million incorporates continued price investments and normalization of operating expenses. So that would be 3 to 5% growth. Adjusted net income of between $1.60 to $1.66. That's about 2 to 6% growth. Really, if you take out that extra week, it'd likely be a relatively flat year. We point out that these assessments assume government foreign trade policies similar to fiscal 2024. So tariffs, they say, while manageable from management perspective, they do add a new layer of risk to the company. Let's look at the valuations here. 2024 actual based on the trailing numbers, it trades at about a PE of 17. Going forward is about 16.5 based on what is expected. So we'd say it's fair value with some risk if tariffs hit the economy hard. Conclusion here, this is a good company, but valuations are fair to maybe even slightly overvalued in the near term given the tough macro and consumer environment. It's a competitive environment now. So that's translating into muted momentum, limited revenue growth, modest profit decline in the last year. But management does seem to be navigating through the headwinds slightly better than expected. They beat Q4 estimates, so they are navigating this environment well. The competitive environment that we're in right now, headwinds likely to persist. The core KPI or key performance indicator that we'd look at here to follow is same-store sales. It's likely stuck at modest growth through most of 2025 with downside risk again if trade wars hit hard. Competition has increased with the entry of Chewy, a US-based online pet retailer, into the Canadian market. So to summarize here, the stock is not cheap enough to attract meaningful inflows from value investors. We monitor it. It could be a name to add if there was a significant discount to the price. Again, we continue to monitor the company. Those are disclosures, and thank you. All right.
Great. I mean, that's a good analysis. So Pet Value actually recently came across my screen while doing the 2025 Canadian Dividend All-Star Report. So I think I ranked them as a secondary. And yeah, your analysis is pretty much spot on there. I mean, it's an interesting company. There are uncertainties too. I mean, there's going to be likely some tariff risk as well in terms of input costs. Retail is a tough business and just, not necessarily a lot of growth right now. So if I were to buy a company like that, that's one where you'd want to be able to buy it at a very attractive valuation.
Yeah, and I think in that report that you're doing too, there are a couple companies that have a little stickier sales that are likely less affected by tariffs, still have more growth and trade at a better valuation with a better yield. So, it's always, Pet Value is a good company, but it's always relative to what else is available. And in the current market conditions, there's some other companies that we like more than that. And we may have, or Aaron may have a recommendation in that respect over the next week or so. May have, I'm saying. I don't want to. He may. We're always looking. All right. We got to move to our second Your Stock, Our Take. I think that is Brennan. And he's going to revisit a company that some people may know. I'm not sure, but Tesla, right? I think we've heard of it.
Yeah.
Fairly high
Hopefully.
profile.
Very high profile.
Yeah.
So I'll do kind of an update on Tesla here, but really, we could probably call it a dog of the week and even month, as the stock is down 13% today. Again, we're recording on Monday and is down 40% year to date. So let's do a little bit of a recap on the stock and look into how the financials have been trending over the past few years. So Tesla Inc., TSLA on the NASDAQ, currently trading at a price of about $226, $844 billion market cap. And of course, they design, develop, manufacture, lease, and sell electric vehicles or EVs and energy generation and storage systems in the United States, China, and internationally. The company operates in two segments, automotive and energy generation and storage. And you can see here, automotive makes up about 90% of revenue in the last fiscal year, while energy generation and storage is at about 10%. Now, if you remember from my 2024 prediction made in January 2024, I predicted that Tesla would decline during the 2024 calendar year from its then current price of $256. And this was based on, number one, declining profit margins as the company slashed prices to maintain market share, and two, potential lower demand with elevated interest rates and more competition from large manufacturers releasing EVs. But despite what I predicted essentially coming to fruition, because of Elon's support of the Trump campaign and Trump getting elected as president, the stock absolutely took off in late 2024, with the stock finishing the year up over 60%. But it really didn't take too long for the hype to fade. Now, looking at deliveries, the company came short of estimates in Q4 of 2024, and for the full year, it reported a 1% drop to 1.78 million vehicles delivered, which is the company's first ever year-over-year decline, with analysts indicating the decline is likely due to rising competition, shifting demand, and overall economic conditions. Now, looking at the financial results for the past fiscal year, total revenue was up slightly by 1%, which was driven by an increase in energy generation revenue by an increase of 67%, but was offset by a decline in revenue for automotive and services of 3.4%. And management noted that the decrease was primarily due to lower average selling prices on its vehicles, as well as a decrease in deliveries. We also saw gross margin and profit margin or net income margin decline in the year, with total gross margin declining to 17.9% from 18.2% for the same period last year, and net income margin declining to 7.3% from 15.5% last year. And the primary reason for the decline was, again, a decrease in total automotive and services gross margin, as well as an increase in operating expenses due in part to the launch of the Cybertruck. So overall, basic EPS or earnings per share was down 53% to $2.23 per share from $4.73 per share last year. Looking at the balance sheet, it remains top notch with cash and short-term investments of $36.5 billion, with debt and leases of $8.3 billion, and a net cash position of $28.2 billion or $8.82 per common share. Looking at the valuation, the stock remains very pricey, trading at around 100 times trailing earnings. And, still even 100 times trailing earnings, even if we exclude the large net cash balance that it has in its balance sheet. And really, since the company got into profit in 2020, the stock has traded with about an average price to earnings multiple of about 100 times. So to conclude here, Tesla's share price had a strong 2024, up over 60%, led by euphoria around Musk's relationship with Trump and his victory at the ballot box. Now, 2025 year to date, the stock has been getting beaten down, dragged lower by its weak fiscal year 2024 results with decreased deliveries, margins, and earnings, and potentially negative sentiment with Musk in news headlines as he is becoming a more polarizing figure to the American public. The balance sheet remains healthy, but the stock continues to be quite expensive. Now, this graph that I have on the right is from Visual Capitalist as at December 2024. So, kind of before its recent drop. But you can see at the time, Tesla continued to be worth more than all major vehicle brands combined. I certainly think Tesla is a decent business long term, but there could be more pain ahead in the near term if growth concerns lead to further compression in its valuation multiple. And with Elon Musk continuing to be at the center of politics, this could potentially lead to boycotts of the automaker, as we have seen over the last few months, and potentially impact demand further if we see further backlash. So yeah, that's my segment on Tesla. Again, I think that it is a decent company. It's just trading at astronomical valuations. It always has. I know that a lot of people have put out there, it's not a simple auto manufacturer. It's a data company. I've seen a lot of these things out there. But the real question is, can it maintain that multiple when it is in the face of headwinds that we're seeing?
Well, it better not just be an automaker, because otherwise it should be declining by 90% tomorrow.
Yeah.
So yeah, I mean, it's a data company, but so is Microsoft, so is Google. They're not trading at 100 times earnings, right? They're trading at like 30 times earnings, less for Alphabet. So, you look at the situation, like you have a company with, a highly controversial CEO, like the people generally, I would think that would be more prone to buy electric vehicles, at least in I would say North America, probably Western Europe, are people that, are not likely to be in line with like, say, the current administration in the US, right? They wouldn't be conservatives. Now there's obviously going to be exceptions to that, but like my view is likely that EVs are not as popular. So, obviously Tesla is not in a good situation here, right? And as a shareholder of Tesla, from Elon Musk's perspective, he probably doesn't care as much because he's, doing things that he sees as being bigger opportunities. But as a shareholder of Tesla, I'd be extremely concerned about that, because you also have a company, that was already, even before any of this happened, you were already starting to see sales slow. and some cracks in the foundation there. So I mean, for me, it doesn't look like the outlook is rosy.
Yeah, and I saw headlines all weekend of this is based off of electric reporting sales in Europe, and across the board, practically without UK was the only country that they reported that was up, but it was 43% down of sales for the month of February for Tesla. That is just massive year-over-year drops for a company that's positioned as a growth company. Whether it's
these are from the Q1 results, right?
Yeah, and these are forward-looking results.
Yet,
exactly,
right?
These are forward-looking. If these are correct and this is systematic and not just some blip, that is extremely concerning when you're priced as a growth company and you're seeing a 40% drop year over year.
And probably you don't get the 40% in North America or China, but like you're still seeing weakness there too. So it doesn't have to be a 40% drop. It can be a lot less than that. And that's still
premium valuations. And if you see a 20% drop, that would be massive.
10% drop. I mean, for 100 times earnings, it's, you want to see 20 to 50% growth or more, really.
And actually, in China, there was a drop. This was from a different report, but it was 49% in February. So cut it in half.
Wow. Okay. So there you go.
I mean, I wouldn't, but
I haven't looked.
And when you align yourself with somebody who's putting tariffs on and people are peeved about that, and, they can act with their, wallet, maybe it's short term. Maybe it's only short term, but there could be no tariffs to come on. I mean, there's certainly tariffs on China, so I'm sure there's a movement there to buy a China-based EV. I mean, BYD is there, right?
Yeah, exactly. I was just going to say, like, even when we did the electrification report, I think that was later 2023, like, I was looking at the guidance from just BYD and Tesla, and again, like the guidance was that BYD was taking over the leadership market share from Tesla, essentially. So, we are continuing to see that where deliveries from BYD are, stronger than Tesla.
Yeah, it's interesting to see how that's going to play out. But you would think there's going to be some backlash from that, and people can choose to buy one EV versus another, or not even an EV, right? And Tesla could get hurt there. Might be just short term.
Yep.
Maybe it's longer term. Those are hard things to protect. But certainly in the short term, the data is suggesting going forward, and that may not even really be into the next quarter, somewhat of the next quarter, but certainly a quarter after that, you're going to see that impacted.
So essentially we can go back in time and give myself a check mark for my 2024 prediction.
No,
right?
because
never happening.
That was
the
only in the
just
year.
wait. Maybe at the end of the year you'll have a much bigger gloat, depending on where the share price is. So
I know I'm just joking.
All right. Let's move on to our final Your Stock, Our Take. It's Perion Networks, PERI on the NASDAQ. And we're going to be sitting down with management sometime next week.
Yeah, so it will be an interesting talk regardless of the outcome, I would say, just because they've had such a turbulent year. Really, the past, I think, about 9 months. I think it was in April when they had their first big drop, their first change. And that's what we'll get into in this and see where we're at more than anything. So if you're not familiar, Perion Networks, symbol PERI on the NASDAQ, is a provider of advanced technology for digital advertising. The company offers solutions for connected TV or CTV, digital out of home or DOOH, social display, video, and digital audio advertisement. The stock is trading at $8.49 a share at $411 million market cap. This is after a collapse in share price over the past year, falling 62%, but it's been relatively flat for about the past 6-7 months now. The first of the two large drops in 2024 was in April, and that was due to changes in Microsoft Bing's changes and to this pricing mechanism for advertisement, leading to an over 30% drop in Perion's guided revenue for 2024 at the time, resulting in a 41% drop in the stock price. The second large drop in June, another change from Microsoft, impacting its search distribution marketplace. Revenue guidance for 2024 dropped another 20% and a 30% drop for the stock price. And they noted that Microsoft Bing was no longer materially relevant to the company. The company has since now shifted to rolling out a single platform model, unifying its brand and technologies under Perion One, where CTV, digital out of home, retail media, social, and open web capabilities are under a single AI-driven platform. The strategy has a focus on AI development for both the customer side as well as operational efficiencies. The goal of it is really to reduce the siloed nature of each of their solutions. They had, they noted, I think it was back to the 90s, some of their software solutions, and it's really to simplify campaigns across all their major channels, just overall making more of an efficient system for both their own internal use and as well as external for customers. So after the Microsoft changes, really, they're more or less forced to pivot to Perion One, and that's the result of it. Shifting to the financials, however, which I will preface with saying these are preliminary as the company has not filed its 20F for the year. They are an Israeli-based company, so they file a 20F once a year instead of a 10K. Performance year over year was just simply pathetic. For the quarter, the big drop being search revenue that relates to the Microsoft Bing changes. It was down 78% to 25.5 million. Total revenue fell 45% to 130 million. EPS down 86% to 11 cents. Operating cash flow down 91% to just 4.3 million. This is really just a culmination of those Microsoft changes earlier in the year and why the stock got hammered so hard. This was expected just to have dismal results after those changes. The company did not renew its contract with Microsoft at the end of the year, but does expect to have some tail revenue, but likely minor into 2025. As well, I will note that the company does have interest income, which supported the quarterly profitability, and without the interest income, it would have actually been a net loss overall for 2024. On the bright side, though, the company's new focus segments did see growth for the entire fiscal year. DOOH revenue grew 50% to 69.7 million, CTV grew 30% to 43.6 million, and the retail media vertical, that is, grew 62% to 80.6 million. So where they're actually focusing now did at least have growth for the year, but obviously only a tiny bit of a bright side when you're looking at such dismal results. What I will highlight is another one of their strengths, though, is their extremely strong balance sheet with a net cash position of 373 million. Mind you, the market cap is only 411 million. That is a $38 million enterprise value. Past operations, the company is looking to buy back shares with its cash, just today increasing its buyback authorization to $125 million. That's a $50 million increase, which it had previously bought back 46.9 million in shares. Buying back a large amount of shares is not really uncommon for when a company is trading at near cash values, as if they don't have a really great use for cash, that's what they'll do. They'll just buy back shares for effectively the same price that their cash is trading at. It's a way to return capital to shareholders. The other potential use is acquisitions to build out Perion One, but the company has stated that they are primarily focused on organic growth at this time. So we'll see if they do end up finding something that fits perfectly, synergizes with their Perion One platform. If not, I wouldn't really expect any acquisition to happen within the year. The company has provided guidance for fiscal 2025, revenue of 420 million, implying 18% year-over-year growth from the midpoint, adjusted EBITDA of 40 to 42 million, implying a decline of 19%. Oh, sorry, that should have been 18% decrease year-over-year for revenue as well, and a decline of 19% for EBITDA. And an ex-TAC or traffic acquisition cost, adjusted EBITDA margin of 22%, a 2% drop year-over-year. So overall forecasting another year of decline, but that's not unexpected given the company was still benefiting from the Bing advertising through part of 2024. They still need to lap those numbers. The company did note that they do not expect the reorganization to be really reflected in the financials until at least the second half of 2025, and not really having the full changes reflected in the financials until 2026. So you're still looking at another full year of financials that are likely going to be weaker overall, but you might see a bit of growth at the latter half of the year. Using the company's guidance, the valuations are EV/EBITDA of 0.9 times, the price to sales of 1 times, and X-cash. If you're looking at X-cash sales, so EV to sales, it's only 0.1 times. Obviously, very cheap on a purely valuation point basis, but the company is contracting and has significant risk with the reorganization of their solutions and products as a whole. So right now, Perion just doesn't fit our investment criteria. The company is not growing, it's contracting, if anything. Perion has highlighted really two concepts that I want to highlight myself, I should say. One being customer concentration with Microsoft. That's always a risk. And that's why when you do look through a company's financials or you do read a report or wherever you may see, and they do have a massive customer concentration, this is the risk actually happening. It's when Microsoft made their changes completely out of Perion's control, and it just has devastated the business and your investment. As well, the other factor I want to highlight is just how much cash can matter for a company. The enterprise value being only 38 million, meaning the value of the cash is roughly 10 times what the market is currently valuing the future operations of the company at. That is just massive. And if they didn't have that cash, they would likely be trading at that $38 million market cap instead of the EV. So that strong balance sheet really saved the investment's downside. And that's why when we're saying that there's really a baseline to a company, and when you look at the balance sheet, that is the structure to your company. That is your foundation to it, and it can't go much below that. Otherwise, someone will acquire, they will do buybacks, and that is return to shareholders in some manner. Obviously, that's not always the case. So in Perion's case, if they do, let's say, do a poor acquisition, even though they say they're only going to do one that has their synergy requirements, if they did a poor acquisition and they spent 200 million of their capital on it and that just falls apart, that can obviously have quite a bit of downside right there. As well, what I will note is it now looking forward, if we can see the company actually continue to grow that CTV and the DOOH channels, as well as the retail vertical, those core focuses within when it hit, and if it can hit its guidance for 2025, it could be appealing. But that is really what we need to see. And it is an uphill battle as there is the recession fears right now, which will impact in advertising demand. So that's even something out of their control, which could hurt the company in the next year. But Perion's growth is much, much more in their own hands compared to the prior years, as they aren't more or less subservient to Microsoft anymore, meaning a major risk is management's execution now. But if they can execute, there can be a major reward, but obviously that's what you need to see, and that's really what we'll be questioning them about in the next week when we do speak to them, as we need to see the plan. Then we need to see them actually hit those results, hit their goals, hit their targets, financial as well as operationally. But for now, we'll could just continue to monitor the stock.
Yeah. I mean, it definitely becomes intriguing trading close to just cash value. And again, I understand we're probably going to be posting some weaker results. And, I ended up writing up a report. We interviewed this company back in 2022 at the same conference, and did up a report. And, essentially, I wrote, overall Perion does screen well, but, given the large customer concentration risk with the Microsoft agreement, we will monitor the business at this time. I think that at that point, it was about 50% of their market cap was in cash. So, still a significant amount, which Brett, I'm glad that you said that, it can act as kind of like a bottom for the stock, having some of that like a cash balance. If this company didn't have that large cash balance, it probably would have been trading, even way significantly lower, a couple bucks or something along those lines. But that was the thing when we were looking at this stock in the past. It was just, is there that asymmetrical risk to reward where we're seeing, more reward than risk? And because of that customer concentration, we were seeing potentially more risk than the potential reward that was there. So, we continue to monitor the business, but it will be interesting to, hear right from management, what they're planning on doing here going forward, what they're going to try and target for organic growth, if they do have a target that they're willing to share. But yeah. Good job, Brett.
I want you guys to ask what they think they can acquire realistically with that money,
Yep.
like what's out there, because that's interesting. Like that to me, I mean, the buybacks, it's nice to see that you don't just want to be sitting there with a bunch of cash on your balance sheet forever, right? So it's good to see that they are returning some of that capital back to shareholders. But really, I think what people are gonna what can really propel the stocks if they could acquire something quite interesting. But I don't know what there is out there that would be in their wheelhouse. I mean, obviously it would need to be something aligned with their business that would add value. Hopefully, not too risky, but yeah, that's what I want you guys to ask.
Yep.
Yeah. And we point out too that they're based in Israel, right? Mm-hmm. So there is a higher level of risk that's associated.
There's a discount.
Lower multiples. Yeah.
Lower multiples. And especially now.
Yeah. For sure. All right. I think that's going to close out our show for this week. Again, we have those live webinars coming up to start next month, April 3rd, 7 p.m. Pacific, April 8th, 7 p.m. Eastern, that full VIP portfolio. If you want us to help you build that simple 2025 stock portfolio, April 13th, 11 a.m. Pacific. That's a 5-hour. The other ones are 2.5 to 3 hour webinars. All right. Again, keep your questions coming into our Your Stock Arte segment. If you are watching this, viewing this on YouTube, smash that subscribe button. If you're listening to this, wherever you consume your podcasts, then rate and review us and keep your questions coming in. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.